This low interest rate environment, it's extremely difficult to maintain the value in assets, let alone increase them. So Godfrey Mutizwa caught up with Hichem Souli, the Managing Director of Cross-Asset Solutions at Societe Generale, to get their views on how to make money in a low interest rate environment.
The point is basically the rate, as you mentioned, are at the lowest almost ever, and it becomes very hard for all the senior clients to generate yield on such an environment. So most of the central banks and senior client, in terms of regulation, they are obliged to invest in govies, US treasuries, etc. And those one having a yield which is becoming almost nil.
Yeah, and when you factor in inflation, in fact, you're getting real negative returns.
Exactly. And even though that you start to go to further maturity, longer maturity, then you start to take much more risk, because most of the market is scared that at some point the ECB or the Fed will decide to increase the rate, and they can have a big drawdown on their assets.
Right.
So the point on our side within Societe Generale is we did develop some strategies in order to help such a kind of client to generate alpha through different asset class, which is ruled by the framework of such a client.
Right. So let's talk about the how. How do you do it? What do you advise them? What do you tell them? Because I'd imagine, for instance, your clientele in Africa would probably be, your central banks, right, like we said at the beginning, and then perhaps the sovereign wealth funds. There are not too many of them, but those that are there, what do you tell them? And how do you do it?
So basically what we tell them is to create a kind of joint venture, or to work closely with the client on a bespoke basis as a team, and to try to open to them all the capacity that we have within our investment bank, and leveraging on our capabilities, be it engineering, within the team that I have. For instance, in Europe, we have almost 35 people working on a daily basis to find some solution to clients, be it central banks or insurance or pension scheme, etc. So the point for us is to open this kind of expertise to such a kind of client, senior client, and help them through our product, our strategies, to generate some alpha. How we do it? It can be, first of all, just to mention those kind of clients that we are talking about. Those kind of clients are allowed only to invest on a very liquid assets, such as Euribor, etc., or UC, or US treasuries, etc. So the point for us is, under that framework, we do some strategy which help us to be long, short, or to try to find the value that there is within embedded to those assets. I give you an example, for instance. Whenever the ECB or the Fed decided, or every month they have their meetings, and they're gonna decide for the target, whether increase the rate, decrease the rate, etc., or to keep it. Whenever they do such a thing, or let's say they decide to increase the rate, you see in the market a movement on the term structure of the rate. Okay, and our team have done analysis over the time, and what we did find out is whenever such a thing happen, you see that the market, in most of the case, is underestimating the level on which the rate is gonna realize. So you have such thing that can be evaluated and that we can catch. So our job is to try to find those kind of alpha, i.e. anomalies or underestimated from the market, in order to help the client to leverage on.
So you're suggesting that when you are able to do that, those returns then are over and above inflation. You get real returns after inflation.
Yeah, our goal, our aiming is to have obviously a positive real return. You see what I mean? So the point is, for us, is to create a return which is much higher than what they would expect by doing just longer term maturity on the US treasuries, for instance. And as well to avoid them, because when you go to longer term on the US Treasury, to avoid them to bear the duration risk that they have embedded to the long term US Treasuries.
So I would imagine if you're talking to an African client, you're saying to them, given this environment, perhaps you should be looking at US Treasuries, but the question is how you do it. What about someone who's looking to invest into Africa? I mean, what would you tell them? Are there any asset classes within Africa that an investor with that kind of pool of money would be looking to perhaps look into and invest, like perhaps South African bonds, like perhaps the Nigerian bonds,
government
yes. bonds?
I mean, the point is to come back to basics, we need to diversify. So the point is, obviously through emerging market like Africa, we can find some niche of bonds which are yielding much higher and which are more appealing than the usual suspect one, i.e. US Treasuries or the ECB. But this being said, since those amounts that are managed by those central banks and sovereign wealth funds are quite big, we need to keep in mind that they need to be able to get their money back at any time, at any point of time. So you need liquidity.
Yeah.
So even though they decide to go for a certain niche on which they feel comfortable, you mentioned govies in South Africa,
yeah.
They need as well to keep in mind that they need the liquidity of the asset.